Good morning, everyone, and thank you very much for joining me. This is the Morning Market Review. My name is Russell Shaw. I'm a Senior Market Specialist at FXCM, and my email address rshaw@fxcm.com. And of course, if anyone needs to contact me, that's the email address to use. And today is Thursday, the 23rd of June, 2022. I'll just bring this high-risk investment warning up. I'm going to keep this on screen for a few moments. And then we will bring up the commentaries disclaimer. And references, MarketScope 2.0, cnbc.com, we'll read that in a moment, possibly TradingView. Then I've just got a few things here on the St. Louis Fed site, which I think probably be worth keeping an eye on going forward. Just before we get into the CNBC article, so I'll short euro yesterday, so I just wanted to show you how that kind of panned out. So here was the short entry, right? Trigger 1, trigger 2. Yesterday morning, when you and I were speaking, we were down here, and then in order for the trade to really work out, we've got to maintain the lower quintile, which of course we didn't. So exited about there. So it was a nothing trade. I think had a few pips in my favor, but the point is, as soon as it started moving against me, you just got to be prepared to close out. The idea here is, so what's the next step? Well, for me, I'm actually looking now at shorting again. I'm just waiting to see if I get a signal, which I don't have, but this to me looks kind of 1, 2. So at the moment, I just want to be clear, I don't have a position on. There's 1, 2, 2, 3, and I'm wondering if we get some sort of movement down here. But of course, I've got to get the right signals, right? So that's kind of, so what am I trying to say here? I'm trying to say I'm looking at the top down and trying to get the probabilities or the odds to work for me. I'm trying to work the odds, right? That's what we spoke about yesterday. Here's the long term. Okay, here's the long term chart. Let's get rid of all of this. We'll read the CNBC market in a news in a moment. I just wanted to do this. Just get rid of that. All right. So this is a weekly chart. So ask yourself, what's the trend here? And the clearest way to get a trend is just to bring in a chart and say, well, which way is the price moving? And the chart will give you an honest answer. He or she will say, well, it's moving down. Okay. So that's the case. Then I want to see if we get a movement down here, where we can add sort of complicating factors. Is, well, are we at support? Okay, so that's the obvious question that we've got to try and answer as well. And it's asking if I'm looking to short Bitcoin. No, not really. It's not something that I tend to stick. So in terms of my portfolio, there would be some passive mutual funds. That's probably sort of the majority. There would be some active management on the stock market longer term, and there would be some trading on the Forex, most notably the majors, because they've got the thinnest spreads. So you go to something like Bitcoin, the spreads themselves are, number one, more expensive. Number two, it's just a an informationally inefficient market. I don't know when some sort of whale is going to come in and disrupt it. So why would I put my money there? Seems silly. So the idea is I would be looking at the path of least resistance. So that's kind of the approach. I know Bitcoin has really sort of gripped the imagination of market participants out there, to the point they debate intrinsic value, no intrinsic value. I see no intrinsic value. Nobody's managed to convince me one way or the other that there is any value in Bitcoin. But I know that there is a informational inefficiency there, which theoretically can work for you, but if it doesn't, you're going to just take a knock. Yeah, no. So my thinking would be similar. So you know, I'm not a Bitcoin trader, but I mean, clearly there are Bitcoin traders out there that are having a field day shorting at the moment. You know. How many trades roughly do I do a month? Rob's asking. I've slowed down considerably, to be honest, Rob. I was much more active probably last year. The markets tend to be are challenging, and I'm sticking. Probably the instrument that I've been trading the most is Euro US dollar. Why? Because it's just completely silly not to trade it. It's the most obvious trend. So that's kind of where I've been focusing. I mean, no use making life more difficult than you need to, right? So this has just been an absolute terrific trend. You know, if the opportunity comes, I'll take the short, but we'll see. Does that kind of answer your question? So much less trades since the market, much less trades this year. In fact, a lot of my positions have been liquidated, like a lot. There's one position I've got in Anglo-American that I'm kind of just watching. I'm not sure whether to liquidate it or to try and just buy some more. So I'm kind of just watching that. All right. Let's just go through to the CNBC. Let's go through to the CNBC note here. European stocks hit for negative open as markets struggle for recession fears. European stocks are expected to open lower Thursday as global markets see renewed volatility after a brief recovery following last week's tumultuous trading. European stocks closed lower on Wednesday, reversing gains made in the previous session as global volatility continued and market sentiment shifted to a more negative setting amid fears over surging inflation and slowing economic growth. US stock futures dipped early on Thursday after the major indexes slipped into the red at the end of regular trading, and investors weighed the likelihood of a recession after comments from Federal Reserve Chair Jerome Powell. Powell told Congress on Wednesday that the central bank is strongly committed to bringing down inflation after the rate hit a 40-year high in the United States. He also noted that a recession is a possibility, a fear that has continued to weigh on Wall Street. Meanwhile, in Asia Pacific, markets overnight sentiment was more mixed as investors continue to monitor recession concerns. On the data front, in Europe, preliminary services and manufacturing purchases, manufacturing purchasing managers index data from June is due for the euro area. All right, so there is I think something that is worth keeping an eye on here, and is the Fed balance sheet. Okay. So this is the balance sheet. At its height, we kind of got pretty close to 9 trillion. This is what the Fed is looking to normalize. All right. So as this rolls over, I think it's going to have a heavy influence in the markets. So I just want to see a little bit more of a turning point here, but it's coming. I mean, at 9 trillion, we know this is being normalized. This data is probably updated, right? It's not that outdated, I guess. We're on the 15th of June, but we've just started the process. There is 3 months of it's about 3 months of sort of a teething process before the sort of they lock in at 95 billion per month, and they want to get this down. So we just want to keep an eye on that. At the same time, it's worth keeping an eye on this chart, which is your money supply. So what we've been saying is that the money supply, the dollar money supply, is going to start coming down. Well, that process already started. It's starting to come down. Okay, this is the freight train. Okay, so let's just see here. It comes down starts its descent April 18th, 2022. Okay, what we can do, again, we won't get into too much cryptos, just compliance, but let's just see what happened in April 2022. Okay, here's this big sell-off in Bitcoin, right? Okay, so we want to just keep an eye on this this M2 money supply now. This is old data. This is already stale. The last time it was updated was on the 2nd of May. But if you go to here, it says the next update is listed, and then it gives you a link to when the next update is. Well, this is the link, and the next update is going to be in 5 days' time. Okay, so we'll get the next update here in 5 days' time. Just want to keep an eye on what's happening with this money supply. So that's important, because it's going to have an effect on this chart here. Not this one. Let me just get rid of that. And it's going to have an effect on this chart here. Let's just go down to the weekly. Let's get a candlestick here. All right, so here is the US 10-year. All right, we go through to sort of April here. This is where the money supply started coming down, right? So it contributed. It was already moving up. It was really moving up by the time. So there's probably that discounting you're talking about, Anna. And then what happens is interest rates get pushed up, and we reached a high. What was the high? Close to 350. Okay, so I think there's more to come here if the money supply carries on being pulled out of the economy. And I think there's a good chance that that gets pulled out of the economy. Why is there a good chance that gets pulled out of the economy? Well, we watch this total assets come down. So this is the, in my opinion, this is the big bugbear. So what happens is the Fed is, I think, from about September. So they're working up towards September. At the moment, it's sort of incremental, but by September they should get to about 95 billion worth of asset sales per month. So what we're looking at here is think about it sort of from your point of view. Just let's just say let's just say we all kind of as an asset we've got let's just say a nice dining room table. Say we've got 2 dining room tables, and we sell one. Okay, so we receive the money. So we've sold the dining room table, we receive the money. We don't have the dining room table anymore, so we've got to take it off our assets because it's not an asset anymore. So we would credit that part of the balance sheet, right? And then the idea here is we'll have that money. So let's just say we put that money into a safe and lock the safe up. Okay, we lock the money. So that money is now out of circulation until we take it out of the safe. So that's effectively what's going on here. They're selling assets. So instead of dining room tables, they're selling financial instruments, which just happen to be treasuries and mortgage-backed securities. And they'll sell that into the market. They'll collect 95 billion per month, and they're going to lock that away into the safe, never to be circulated until it comes out of the safe, right? And when they lock that out of the way and it goes out of circulation, well, I would expect this to carry on moving downwards. So that's the key. Money supply looks to be coming down. This is key. Why is money supply coming down? It's coming down through this quantitative tightening process. But the important result for us is that money supply is leaving the economy. Why is that such a big emphasis? Why do we have to know that? Because it's going to influence our trading one way or the other. And we are traders, we're market participants. And it's these fundamentals that are going to be driving the technicals. So just sort of very quick monetary demand supply. So my supply of money is vertical. Why is my money supply vertical? It's vertical because right now, according to the data, we've got 21.696.8 trillion in circulation. We don't have a penny more and we don't have a penny less, right? We've got a fixed amount. So if it's a fixed amount, well, that has to be represented vertically because it's a fixed amount, because this is quantity right here. Now, as that quantity comes down, okay, we're going to shift. We're going to shift this way. Going to shift this way. Going to shift this way. And what's going to effectively happen is this money supply is going to interact with the economy's demand for money. Okay, so there's some sort of negotiation, some sort of auction that goes on between the demand side and the supply side, and that finds the demand and the supply side settle on an equilibrium based on the quantity. Okay, so what's the equilibrium that they settle on? How is that measured? Well, it's measured by interest rates, because that's where the negotiation takes place between the demand side and the supply side. So what's effectively happened here, if the money supply gets pulled in, our interest rates are moving up. Okay, they're moving up from that level to that level, right? We can all see this higher. And also that's high. So if the theory says that interest rates are going to go up because money supply is going to be declining, well, we go through to our what we just you can use sort of the 10-year. I think it's a good proxy for interest rate, and we just wait to see how that negotiation is moving along. Is it moving along smoothly? Is it moving along more sort of higgledy-piggledy? No, this is kind of where the negotiation is being represented. And then that negotiation's never smooth. It may be smoother, but it's never smooth. So that's why we get the peaks and troughs, peaks and troughs. So any sort of trough over here becomes exceptionally interesting because as the liquidity gets softened out the market, that's going to lead to another round of negotiation. Okay, and we want to just try and see what's happening in terms of the interest rates. Now, why would you want to look at the interest rates here? Why would you want to look at the interest rates here? Because they are effectively driving the market. All financial instruments will have some sort of causality linked to interest rates. And what we can do is we can just put in the US dollar underneath. So we throw in the US dollar. All right, and it's not difficult to see what's going on here. Okay, now where it gets really interesting, I'll show you something in a moment. Where it gets really interesting is from March. I think it's March. I'll show you why in a moment. Okay, so there's the technicals representing sort of the fundamentals. Where does this get interesting? I think it's March. Let's just bring in the correlation coefficient here. And what we're looking is we're trying to get a correlation between the US 10-year yield against the movement in the US dollar FXCM basket. And we'll just bring that up. And this is where it gets interesting. There. From this level. So why does it get interesting from this level? Okay, because the correlation coefficient starts increasing to a level now where we almost perfectly correlated, which won't hold forever, by the way. It's going to depend very much on how the monetary policy plays out, okay? And that is subject to change, so we have to be on top of that. But right now, we've got an almost perfect correlation coefficient. What does that mean? It means they're moving sort of lockstep. Okay? As interest rates move, the US dollar moves in the same direction, pretty much on a one-for-one basis. Not quite one-for-one. It's kind of the locksteps at 92% correlation. Now, we've got to be very careful here because correlations can be accidental. You could get two instruments lining up that are perfectly correlated, but actually have no relation at all to one another. For example, just to make it sort of really sort of a really sort of ridiculous example would be, well, you know, on Thursdays, the wind blows, when the wind blows north from a northeasterly and it rains, the dollar moves up. And that tends to happen 92% of the time. And well, clearly it's an accidental, I mean, it's an accidental correlation. It's not going to there's no ways that's going to have any relevance because it's nonsensical, makes no sense. So the question we've got to ask ourselves is, does this make sense? What's so special about March? And what's so special about the 14th of March? Why did I pick the 14th of March? Well, it just so happens that it just so happens it's not the 14th of March that I'm picking. I'm just picking the 14th of March because it's a weekly. But if I had to go down to a daily, I would actually move this to the 16th. Okay, because something happened on the 16th. not the 14th. So something happened on the 16th. The 14th, the Monday. Okay. The 15th, I believe, was the Tuesday, and the 16th, the Wednesday. What happens on a Wednesday? Federal Open Market Committee statements, press conference. So now we go back to March and we think, well, okay, what happened in March 2022? Well, that's when they announced the quantitative tightening. That's when they announced the quantitative, guess what? When they announced the quantitative tightening, correlation coefficient tightened up. Okay, so that's what I think is happening here, subject to correction. I'm going to tag on that subject to correction, but I think that's what's happening here. If I'm right, okay, subject to correction, well then this becomes exceptionally important for us. This becomes exceptionally important for us, okay, because right there is the underlying fundamental. Now it's our job to line up the trading signals based on this fundamental, if it's true. Okay, and that's the key, if it's true. So Anna's just asking, can we add Bitcoin here? I will. I'm going to tell you what the issue is here. I'll tell you what the issue is here. We'll tag on Bitcoin, and then I'm going to take it off. There's a compliance issue here, and the compliance issue is as follows. The Financial Conduct Authority, has made it very, very clear that cryptos are off limits to retail traders, off limits, to the point you can't market these, you can't promote cryptos to retail traders in the UK. There's another complication. In that the South African entity, the FXCM South African entity, is now being absorbed into the UK entity, so it's subject to the same regulation. So that's the issue. So if you're a professional trader in the UK, you are able to trade cryptos, but only if you're a professional trader. If you're a retail trader, you're not allowed to, and we can get into trouble for promoting it. So in terms of this, that's why I've separated the Bitcoin, the crypto minute. That's why I think we've got to put more emphasis on the separation. So, and it's really a compliance thing. So what we're doing here is we're not promoting. I'm just going to make it very clear. There's no promotion here. All we're doing is we're looking at this in terms of an educational type of what is the correlation. And it's very clear to see the correlation here is, whilst the dollar has a perfect, not a perfect, a close to perfect positive correlation to yield, is pretty clear that Bitcoin has an inverse. What we can do is we can actually pop in another correlation coefficient, and we'll just put in Bitcoin. Again, take this only as an educational tool on the correlation coefficient, making that very, very clear. Okay, so let's just take a look. All right, and you can see that it dropped. Funnily enough, it kind of moved in. That's quite odd. But it's now moved back to a significant negative 61, and we'll see if that kind of moves further to -1. Having said that, I'll just take the Bitcoin off. I don't want to do more analysis here. I think it's very important for us to be responsible and just keep it, separate to that Wednesday, the Wednesday webinar. But the idea here is you can clearly see that something seems to be happening between the yield, the dollar, the correlations, the quantitative tightening, and the money supply. And the question is, can we take advantage of that? And my opinion is we probably could, but we have to be careful, because assuming that the correlation coefficient holds, and assuming that the reasons for the correlation coefficient are correct, then over the long term, okay, dollar's going to move in the same direction. So there's obviously some big ifs there, right? What are the big ifs? If the correlation coefficient holds, if the underlying reasons prove correct. Where the complication arises is it doesn't really matter if that's right or wrong in the short term. In the short term, the correlation is going to be exceptionally volatile. In other words, even if over the long term we expect US dollar, in the short term we can still see US dollar pullbacks. That's the ebb and flow. That's the corrections. That's the impulse correction. That's the peaks and troughs. So we can still be on the wrong side. So we still use money management and we still use stop losses. There's just no negotiation there, because whilst long-term equilibrium positions are valid, there's no correlation in the short term, and we tend to operate on the short term. Very few of us hold for the long term, although I would suggest if somebody is really kind of successful in the investment game, they tend to gravitate towards longer term positions, right? So that's something that we just need to keep an eye on. So having said that, let's go back to that euro US dollar. Okay, let's go back to that euro US dollar. And it now makes kind of sense why the rallies are interesting to me. In fact, this movement here is exceptionally interesting to me. Now, please don't take whatever I say as advice. I'm not licensed to give advice. I'm probably going to look to short euro US dollar today if we get the signal. Is it going to be a successful trade? I have absolutely no idea. It could be a losing trade. So if you sort of bet the farm and it turns out to be a losing trade, you're going to lose the farm. Okay, so the idea here is you have to use risk management, correct risk management. You have to use stop losses, just like I did yesterday. Entered here, exited here. Entered here, exited here. This is probably the next chance. Will this be a successful trade? If I get the signal, I have no idea. I have no idea. It's got to get to the 20 level and it's got to hold the 20 level. If it gets to the 20 level and holds the 20 level, I'm going to move the stock down. And then when the swing is over, I'll get out. So that's kind of what I'm looking to on my account. Whether it pays off or not, I don't know. But I'm going to have an acceptable loss limit built in. Acceptable loss limit built in. Okay, so that's kind of the idea here. Now, yesterday, let's just tie this in with what we spoke about yesterday. Instead of just doing the underlying fundamental analysis or the technical analysis, if we just think about now in terms of being a punter, right? How could we assign probabilities to this? Well, you've got to have some sort of methodology to assign whether it is a think. And again, this is just it probably requires more thought. But I think what we can do is we can approach this effectively in two ways, but the two ways have got to be linked. They're not in isolation. But if we split it, I think it kind of makes it better. So we've got to have a way of knowing if we are. So we're going to use 50% as a yardstick, as a measurement, like a coin toss. So I'm going to get into a position, and either I'm going to profit or I'm going to fail. It's a 50-50. Either I'm going to get my stop hit, or I'm going to hit my take profit. It's a coin toss. Okay, so that should be our default position. We start off at 50-50, knowing that we are either going to profit or we're going to lose. Either is okay. Clearly, we don't want to lose, but we've got to be comfortable with the fact that it's effectively a probability, a game of coin toss that we're playing. Either we're going to win or we're going to lose, and we've got to be happy with that. Okay, got to be happy with that. So that's the first thing that we've got to understand. The second thing, actually, I don't think we have to make more complicated in what can we add to the punt that gives us a slight edge. How can we turn that probability from a 50-50 to a plus percent? Either a 51, but obviously if you can turn it from a 51 to a 60% chance of success, to a 70% chance of success, to an 80% chance of success, that's what we're trying to do. Now, we'll never be exact with that. Okay, so you'll never get the probability exactly right. But what I'm suggesting here is we start off on a baseline of 50, and then we've got to think of some reason that 50 is now higher than 50 in terms of a successful trade. So if we're looking, a success would be if we're going long, okay, a success that price must appreciate. A success if we're going short is that price must depreciate, okay? So we need to get some sort of reason to be more optimistic that it's not just a coin toss. Clearly, if we can get that reasoning, then the odds for losing a trade decline as well, but they're still there. Okay, so the probability. So the probabilities, we want to get a plus in the direction of a trade, and we want to get a negative, in the sort of adverse outcome. So one of the ways to do that clearly would be to do exactly what we did this morning, do some sort of analysis. Okay, so assuming the analysis is correct, then there is probably a plus that we can add here. Now that analysis could be a technical analysis, it could be some sort of fundamental. Technical, it could be a momentum reading. So that's what we try to do in our scalping. In the scalping, we're trying to get a higher probability. How are we trying to do that? We're trying to scalp into daily momentum. We're trying to scalp with the daily momentum. So we're trying to, so we just want to see so we're trying to just improve this 50-50 outcome. So that's the first part. Okay, that's the first part. Okay. So the second part, of course, is the risk reward, which is probably more important of the two, but I don't think can be isolated. I think the first and the second aspects are effectively two parts to a system. If you're missing one, you don't have a complete system, right? So then the obvious thing here is, well, what's your risk reward profile? What's your risk reward profile here? So if your risk reward profile is 3-to-1, 3-to-1 means you are getting $3, but you're risking only $1. Can you kind of fit that in with your probabilities? So we'll do a very good example here just to highlight the point. Let us assume, let me think which is the way I want to do this. I want to do this in two ways. Okay, let's assume that, okay, I think this will drive home the point. Let's do this in two ways. Let's say that there is a 1-for-1. So you're risking $1 to gain $1, and you now are operating no better than a coin toss. Okay, you're operating no better than a coin toss. You've got 10 trades. Okay, 5 are winners. That means you've made $5, right? 5 are winners, 5 will be losers, because you're operating on a coin toss. Trading costs aside, you've made -$5. Okay, so on a 1-for-1 basis, at 50%, your net position 0. The position is 0. So now let's just say that you move this from a 50% to 60%. So somehow you move this 50% to 60%. Well, that gives you now 6 winners at $6, and 4 losers at $4. Gives you a net position +2. Okay. So if you work with your probabilities here, just tweak it slightly, and you keep the same risk reward profile, that works. What happens if you do both? Say you've tweaked it now to 2 to 1 at 60%. Okay. Well, let's do 2 to 1 still at 50%. So 5 winners at 2 will give you $10. 5 losers at 5 give you 5. What's your net position? That's 5, right? Think about it in terms of 6. 6 winners at 2 will give you 12. 4 losers at 2. It's interesting. Okay, 6 winners at 2 is 12. 4 losers at 2 is 8. Your net position is 4. Okay, that's interesting. Is my math right here? 6 times 2. No, it's not. Of course, it's not. Okay. It would be 12, 12, 4, and what's your net position? Is +8. Okay, so you can see the big effect. Sorry, my math was I don't know why I was timesing like 2 on a 2 to 1. I lost my marbles for a moment. All right, but you can see that there is a huge advantage of kind of tweaking the first and the second, right? Of the two, which is more important? Well, clearly number 2 must be more important. Clearly, this has to be the more important one. Why do I say clearly? Because without adjusting a coin toss, you can still become profitable by tweaking your. See, in fact, you could still be profitable at a negative probability. You can try that for sort of homework. Think about a 3 to 1 reward to risk on a 30% success rate. You're still going to come out net profitable. So this is the way to perhaps think about your trading. The question is, okay, well, how can I get an advantage on my coin toss? So that's your first question you've got to answer. How do I get an advantage on my coin toss? Okay. The second question is, how can I improve on my risk to reward profile? And of the two, the second question is the more important. All right, I think we will leave it there. Any questions, guys? Any questions? All right, then I think we will wrap up. Yeah. Have a good day, good evening, and we shall speak tomorrow morning. Thanks, guys. No worries, Rob. Okay, yeah, shoot me an email.